Good morning, everybody. This is uh, this is very nice to actually do this again. I've had the pleasure of moderating this panel, I think 3 years now, and it's always an exciting time. Hope everybody had a good Halloween yesterday in the freezing cold. I know I was. Let's get right into it. So we have a great panel here, and when we selected the panelists, we wanted to have a little bit of diversity talking about capital in 2024. And given the macroeconomic situation, given where we are with interest rates right now, we needed to have different perspectives. So, I didn't come up with the title Lions, Tigers, and Bears, but we have a funder, an originator, and a lawyer. And let you figure out who's who at the end of the panel. So we have Jason Croft of Miller Thompson, securitization specialist. We have Justin Limbright of 990 Capital, which is our funder. And we have William Breton of Iceberg Finance, based out of Quebec. Why don't we get right into it? So we'll start over with you, William. When I was thinking about the last couple of years for you, you've had an exciting last couple of years. You made a significant acquisition of iFinance in 2022, but happened to be a very interesting time in the market because right after you completed that acquisition, we went through a rapid rise in interest rates that we haven't seen in a generation. So I'm curious, how did that affect your integration plans? How did that affect your strategy for a whole new vertical that you were entering into?
Yeah, so that's a really good question, and it's something that we couldn't have predicted, that's for sure. So we acquired iFinance Canada in April 2022, and if we go back to April 2022, the Bank of Canada rate was at 0.5%. In March, it was 0.25. We got that first increase in April to 0.5%. And then fast forward to today, the Bank of Canada rate is at 5%. So when we take a look at that, for sure, when you're talking about a lender like us, well, it has a huge impact on your margins. So we went through the whole due diligence process, went through the acquisition. You do all these projections for the short term, and then that environment happens. So you take your projections and throw them in the garbage because they're not really useful anymore. But to understand what decisions we took and how we adapted, I think it's also important that we go back to how things were in 2019, 2020, 2021, 2022, we were in an environment where interest rates were at record lows, delinquencies were low, losses were low. So it was an environment in which a lot of lenders in the industry in general focused a lot on the top line without giving too much attention on the bottom line of their business. Then comes this environment where interest rates are much higher, and then all these lenders realize, hey, I'm not sure my business model is going to be able to sustain such a high interest environment, so there's changes that I have to bring. So specifically for us, we had actually been disciplined in 2019, 20, 21, 22, so there aren't any drastic measures that we had to take, but there's certainly questions that we had to ask ourselves. And those questions were mostly, how do we get more nimble? And also, how do we want to get more lean as an organization? And we do things a bit differently at Iceberg and iFinance in that we have our own technology, so we use our own LMS, our own LOS. We don't use any third-party providers, so we have a team of about 20 full-time developers. And the focus with our team was really dig down in every department and look at how can we automate the processes and streamline the processes as much as possible. A specific example could be our credit adjudication models that we really automated and adapted to the environment that we were in. I know it's trendy words, but machine learning, artificial intelligence, those are all things that we use to make sure that we adapt it as quickly as possible. So that's where our focus was. I mean, today, a year and a half later, if you were to ask us, are we happy with the iFinance acquisition? The short answer is yes, we're extremely happy. We'd do it again with our eyes closed. In the short term, I mean, there are some things that we hadn't forecasted that we had to adapt, but in the medium long term, the reasons why we acquired that business in terms of diversification, in terms of growth, in terms of the profitability and added value that it would bring are there in the medium long term. So we're really happy a year and a half later.
So what I heard from that is the disciplined approach that you had going into the rising rate environment helped you as you were navigating through it. But I liked the answer about, you throw your strategy out in the garbage. So let's talk about your strategy and whether or not you threw it out in the garbage, Justin. Thinking about that, you fund a lot of originators, and you've been doing this for a very long time. How have you been able to navigate this environment? And in particular, how have you been able to support your originators through what arguably is a really tough time for them?
Yeah, thank you. And I know Will, I was intimately involved in that as well, and he's genuine when he says all of that. So he touched on a lot of points there. I think from our perspective, and there are two kind of ideas that come to mind, both on the funding side and then on the financial covenant side. So as these rates have increased, most originators have now had many months now to kind of get themselves balanced and sorted in this environment. Thinking about the funding side, so you're going to have originations, they're going out at a certain rate, making sure that you can timely fund that, making sure that your master agreements are in place such that you can, your frequency of funding or your minimum dollar size, they're all aligned to your business. And then on the other side, the financial statement covenants, oftentimes in most of our facilities, we'll have some type of income statement covenant. So whether it's profitability, leverage tests, all of those things, the rising rate environment has just led to squeeze in all of that. So that compression, it's very important that you're having conversations with your lenders, your funders, in advance of any of these headwinds, because that'll just make the process go a lot more smoothly for both parties involved.
Makes sense. Switching gears, we wanted to get your perspective on this environment, Jason. As somebody who works in a lot of securitization structures, certainly you would have seen some interesting trends that have emerged in credit agreements and structures. And in particular, I presume there probably has been some situations where you've had to bridge the gap between a funder and a borrower. Wondering if you can describe that.
Absolutely. First of all, thanks for having a lawyer on this panel. I hope I get invited back. And one of the benefits, I think, is we look at a number of different perspectives. Most lawyers represent banks and financial institutions, originators, borrowers, and the like. And so we can start to see what are the patterns. And I like to say there are three key patterns I have seen and my peers have seen. One is structure. So people are asking questions about how do I separate the originator from its assets, or how do I separate the good receivables from the credit risk of the originator? And so the first speaker today spoke about SPV structures and the cost and the considerations putting them in, but at the end of the day, more and more questions are being asked around how do I do that? How do I create a structure that separates the originator from those things that I think I can fund against? And the answer is, hybrid structures where you create an SPV that acquires the assets and then enters into the conventional borrowing. We're seeing those. We're seeing conventional lending. We're seeing increased credit link notes and credit transfers and credit derivatives, which tells me something about where we are in the business cycle. So that's one. Two is remedies. People are asking more and more questions about, okay, I put in place this credit facility or this receivable purchase agreement. What happens when things go bad? And we're having more conversations than maybe we would like with our bankruptcy and restructuring lawyers, because that's where we are. And so wherever you find yourself in this journey, you should be able to answer those questions about what happens if things don't go well. And the answer is a properly structured transaction for a lender is designed to be effective, not just in good times, but in bad times. The third trend, we call it various things. We might call it sustainability. We might call it transitional economy. We might call it ESG. In some circles, that's not a great term, so we lean in on sustainability. But the answer is more and more federally regulated financial institutions, in particular banks, but others, pension funds, investment funds, and the like, are asking questions about your carbon footprint, your ESG compliance, your track to sustainability. Those questions are maybe being asked to some borrowers for the very first time. And if I could leave you with one thought, if you haven't been asked questions about ESG and sustainability, you will soon. If you haven't heard about OSFI B15, which is a guideline imposed on banks, you will soon. And the answer is they have to comply with increased and enhanced disclosure. And if the banks have to comply with increased and enhanced disclosure, guess what? They have to get that from their customer base, and it will inform how they use capital. And in a capital-constrained world, if you can't figure out structures, remedies, and sustainability, I think you will be left behind. And so we're trying to help our clients with those themes.
We've certainly seen that trend emerge in our business as well, and I know CLA has a sustainability finance summit as well in addition, so they've been talking about it a lot. I'm curious specifically on that ESG side of things, Justin, how have you approached that? Have you been seeing that as an emerging trend as well?
Yeah, I would see it's emerging. I wouldn't say that we're yet there. To be honest, I would think that Jason's seeing a lot more deal flow as far as the ESG component goes, but yeah, we're not intimately involved. I would say funders that we're dealing with are starting to talk about it. It's, again, to Jason's point, it's whether the originators have the data yet, and are they building that data, because it is coming. It's an inevitable wave.
Yeah, and Jason, I think it's fair to say that this is being driven a lot by the LPs of the funders, correct?
It's a range. So if you are partnering with a Canadian pension fund, it's every single Canadian pension fund has ESG or something like it in their investment committee. Most international banks have ESG in their investment committee or analysis. Doesn't mean it's the only consideration, and at times there's a pendulum where there's too much consideration or not enough, but it forms part of the consideration in increasingly in lending and capital market activity, and we would all be well served to begin to get our heads around it.
Makes sense.
Can I just add so maybe the lender's perspective as to the funders and the relationship? I mean, for us as lenders, our primary resource is money. And the day we don't have any more money, any more funders, like, we can't operate our business. So the relationship with the funders that we do business with are of utmost importance for our business. And we've seen over the past 12, 18 months that, like, the due diligence is very thorough. They ask a lot of questions. They want to make sure they understand what's happening within the company, within the industry specifically. But, I mean, can we really blame them? Just because of the context we're in, they have all these questions, and they want to make sure that they invest in the right companies and the right partners. And for us, we really see our funders in terms of being long-term partners that are going to support the growth of the business. And our way to work with them is to really be as transparent as possible. We share with them our strategy, where we want to go, what we anticipate for the next 12, 24 months. And when you're able to share that plan, establish KPIs and objectives that you can then reach and execute on, well, when you actually deliver on what you're promising, that brings a level of comfort, adds to the credibility of the relationship, and really it allows to build the foundations for long-term partnerships with funders.
Makes sense. Thinking about that long-term partnership with funders, something that's been percolating a lot lately, just in chatter around our office, is this prevalence and rising emergence of all these private credit funds around the globe. It can't go a week without a new private credit fund being announced, and I'm thinking broadly, not just in specialty finance. It seems as though a lot of capital is getting put into the space. It seems as though capital is being moved away from equity markets into private credit, yield instruments, and the like. And whether there be sponsor-backed funds that are focused in the private equity space, or credit funds that are focused in non-sponsored deals, maybe in specialty finance, for example, there's a lot of capital. How do you view that right now? And do you feel as though that it runs a risk of an oversaturation of the market at all?
Well, I hope not. I guess would be the initial response. No, forecasting something is a bit of a challenge, but I would say, I think Andrew spoke to it, first or second period. I think for that, I think we're probably in the first period, and I would hope that it's a better first period than the Leafs last night. But looking at kind of private credit in Canada, and oftentimes, from our vantage point, it's calling private fixed income desk or private debt desk, and those structures are very tried and true, and they've been tested for many years. And those are kind of high advance rate, a small equity component that's oftentimes held with the originator or servicer. And then if I contrast that to, say, the U.S. market, where you look at, I read a stat, I think out of the great financial crisis, the assets under management were around $235 billion. Now it's sitting at $1.4 trillion. So the growth is not stopping. So as far as, those structures are a lot more nuanced. There might be an advance rate from the senior that's a lot lower, a junior piece, an equity piece, and they're all held by non-originator, non-servicers. And so I think there's, do we run the risk of overflooding? I think that there's still a lot more money to flood in. Where those assets are deployed might change as things like banks start coming back into the market, BNS and SLC announcing their partnership. Like there's a lot of bigger capital that's flowing in as well. So maybe the private credit funds, maybe they have to shift their focus. Maybe there's something else to be had. But no, I don't see the prevalence or the emergence that kind of started from after the great financial crisis. I don't really see that slowing down anytime soon.
Yeah. Sorry, go ahead.
I just wanted to say, from a lawyer's perspective, we speak about the financial services or the financial regulatory regime and system in Canada. It's a challenging one. I don't particularly envy lenders, financial institutions, when they want to deliver capital. It's not easy to do that in Canada. We know that. We know it takes time, and it's only getting more complex. And I suspect part of the emergence of private debt or private credit is the fact that it can be easier in Canada to lend on an alternative basis. You create an LP, you obtain capital, and you can lend money largely on an exempt basis. Whether, I'm not a policy expert, but whether that is at least in part the reason for the emergence of private debt, one should reflect whether that is desirable, whether that reflects all the protections and benefits afforded to regulated institutions, but that's at least in part the emergence I would expect.
Yeah, that makes sense. I mean, I think what we have witnessed just in our business is there seems to be a ton of private credit focused on private equity sponsors and doing those types of transactions. There is still a demand to have more capital flow towards asset-backed sectors, and especially finance being one of those, where you can have real collateral on a diversified pool basis, and so that seems to be a trend that is continuing, and I think we would tend to agree with you that market probably can absorb that quite well. Let's shift gears to M&A. When we think about capital, we often think about the need for capital, and M&A is certainly at the forefront of that. William, as we mentioned before, you took a big step with iFinance some time ago. Now in this environment, how are you thinking about M&A? How are you thinking about your strategy? Are you acquiring into new verticals? Are you thinking about expanding loan book? What is on the mind of your M&A strategy right now?
Yeah, that's a really good question given the context. So iFinance was our first acquisition, and our high-level vision for our group is that we want to diversify into multiple industries. So Iceberg Finance initially, and still today, we're in the automotive space. That first acquisition with iFinance gave us the opportunity to go into unsecured lending into industries that we were not. We really have a two-pronged approach, which is, first, we want to develop organically our respective businesses in the geographies and the markets that we're in. So we have solid sales teams, they have objectives and strategies, and we're looking for them to execute on that strategy and really grow the business organically. The other part of the approach is that we want to grow through M&A. So we've looked at a lot of acquisitions since iFinance, and the biggest difference that we're actually seeing, and we have a lot of investment banker friends here today. You're an example, so you know even better than I do.
We're the best ones, though.
But we're seeing a lot of companies that are not as profitable as they were. Ratios are tighter. It's the funders to the banks that are financing the transactions are much tighter in terms of the credit adjudication that they give. So it's harder to close transactions than what it was 12, 24 months ago. So we've looked at a lot of transactions. We've been very disciplined. None have worked, but we still are very interested to doing an M&A. And the way we look at acquisitions, I'll go very quickly over them, but there's 5 things that we look at. The first one being diversification, because that's specifically linked to our vision of being able to enter new verticals. We'll look at profitability. So is the business profitable? Does it have an added value for our group? And if it doesn't, because often when we look at M&A, we have that wishful thinking that we're going to come in and turn things around within a month, and suddenly the business is going to be profitable. But in real life, that's not what happens. And to turn a business around, it's a lot of work. So that's something that we need to be very realistic about. We'll look at growth. Are we able to grow organically, grow the portfolio, grow, like I said, in other niches? The management team, how strong are they? Because if you want to integrate a business, you won't do it on your own. So you need a strong management team to make sure that the integration is as seamless and quick as possible. And the last one would really be the culture of the business. What is the culture and what are the values of the company? Because if you're trying to integrate a business and there's a huge cultural clash, chances are your integration is going to be pretty tough. So those are the 5 pillars that we focus on.
I'm going to unpack that a little bit because there was a few things that you mentioned that struck a chord. So one, when you mentioned profitability, there can be situations, and I think you've seen many of them, where fundamentally it looks like an interesting business. It's in a growing area, but they have been capital constrained. And as we know, many times profitability comes after gaining some scale. You have scale now, so certainly Iceberg and iFinance would be in a little bit of a different situation. But some of the earlier stage companies may not have the scale to be profitable. How do you assess those opportunities in particular? Because sometimes it's a little bit of a leap of faith.
Yeah, so there again, I think you need to be very realistic in the sense that if you're about to acquire that target, what are you going to do with it when it comes within your environment? So maybe for us, it would be our technological tools, the IT. What synergies can you bring that can actually have an added value for that business? And when you're able to do these projections in a realistic way and you can see that added value come on, then these acquisitions actually make sense. And that's where, when you get scale, because it's pretty tough to turn a profit, like you said, when you're very small. But if you get scale and if you have that vision that you can grow the business, that's when it can actually be very interesting.
Great. So Justin, from your portfolio's perspective, the borrowers that you work with, are you finding that they are opportunistic right now or looking at M&A opportunities opportunistically? Or are you finding like they're more protecting their home turf, if you will?
Yeah, no, I think opportunistic's the key word. So there's only acquisitions if they are opportunistic in nature. You have, obviously, as we spoke about earlier, there's cost of capital that's at rock bottom levels. It's come up. A lot of companies were started during those times. Profitability is being pressured, and so now companies are maybe dipping their toes in the water looking for some of those buys. On the flip side, somewhat recent news a month or so ago, there was what appeared to be a fairly strong equipment finance company that was acquired by a credit union. So again, maybe that's mandate driven, not sure, but maybe that's also just a sign of things to come and that snowball effect of now there's some out there that are looking for those opportunistic buys. Yeah.
Jason?
Yeah, what I would add is that my perspective is clients that are purchasers want to buy assets. They're excited about buying assets. They can consummate M&A transactions. The question, the key linchpin is, can you consummate an acquisition financing? And so the time it takes to affect the debt piece is the linchpin to it, from my perspective, of doing an M&A. So unless you have a war chest that you can just use your own cash, you need to access capital. And the easier it becomes, and whatever efficiencies we can engage with fintech, with new technologies, to narrow the gap or the time it takes to consummate the financing piece, we will have much more M&A, because we have clients that want to complete these deals, but it does take time for various good and legitimate reasons to consummate the credit.
So from
Karen Gita was going to say you might be best to answer this question. You see a lot of deals on your desk. So.
We do. So I think we would agree with what you're saying. I think there are many of our clients who are looking at the market right now and saying this is a real good time to take advantage of M&A. Valuations have certainly come down, and they're eagerly looking at opportunities. The crux, though, is, I hate to say this, Justin, sometimes the funding is not there to back it up. And because there is a little bit of a curtailment in capital, or there is a scenario where it's going to take a long time to kind of figure out. But we are working with a number of originators on thinking about, are they expanding verticals? Are they going to be expanding their loan book portfolio and the like? So we are seeing those situations, but it's right now it's a handful of opportunities where it checks all the boxes, and I think William's acquisition criteria would fit in quite well with a number of the folks that we're dealing with, definitely. So what I heard from Jason's response, though, Justin, is funders need to move more quickly.
Yeah, and then I guess at the top we talked about, is there perhaps an overflooding of capital? So I guess To echo back to that, no, I don't think there is. We could use more capital.
Definitely, definitely. So, we always like to leave these panels with pieces of advice. When we're thinking about the originators in the room in terms of how to access capital and, one piece of advice that you can leave them with, what would it be? I want to start with our good friend Jason.
Maybe two pieces, if I may. One is we'll get a term sheet on our desk and we'll be told we're closing in 30 days. And I'll say, well, had you thought about this, this, and this? And then all of a sudden 30 days becomes 50 days, not because of anyone's fault. It's just you have to anticipate in advance what's required and engage your advisors before you consummate the deal in principle. And the second piece is if you have accountants in commercial aspects and legal aspects, are they aligned? Because we find the most challenging deals are you have an accounting treatment you want to achieve, you have commercial aspects, and you want legal treatment. Do they all align? And if they don't, it's because you probably haven't been talking in advance to prepare it, in my estimation.
That makes a ton of sense. I mean, and we've seen that in many transactions, and vetting out that initial term sheet is a very good use of time. Justin, words of wisdom from you.
Yeah, and Andrew hit it in the first segment. I would say if you're growing and you're on that path, make sure you're tracking PDs, LGDs, the auditors coming in place, all of those things. Make a funder's life easy would be one of the simplest things to say. I would, as companies do grow, I know oftentimes they also look for multiple funders to come in place. Maybe with this rate environment, now is the time to not only look for multiple funders, but different types of structures. So don't get two funders that have identical structures. Maybe get one that's a floating rate. Maybe get one that's a fixed rate. Start to look at those things as well.
Makes sense. William?
I'll maybe answer the question more in the perspective of how companies should think about their growth in the current environment. And I'll go very quickly over two things. The first one being, I think companies should think about what's the perfect balance between the growth that they want to reach, but also the profitability to be able to go through the environment that we're in. Because we don't know if we're at the peak, if it's going to last still 12 months, 24 months, like who knows where we are. So that's an important point. And I think that as businesses grow, there's a very important part that the leadership has to play, which is their role is to establish what the vision and what the values of the company are. And once they have that vision really established and really clear, you have to find people and build a core group of people within your company that are going to be actually extremely motivated by that vision that you have. Because if you want to scale, it's not something you're going to be doing on your own. So once you have that core group of people, just give them the resources, give them the tools to succeed, and just let them flourish. Let them work, let them make mistakes, because if you want to grow your business, you have to do it as a team, and I think that businesses have a responsibility to create that environment for the people to be successful within their organization.
Great, and even though nobody asked me, my piece of advice would be hire an advisor, and we're available if you need us. So just to conclude, one last thing, lions, tigers, and bear. Who is the lion?
I hope I'm the lion. I won't.
Okay.
I love salmon and a good nap, so I'm going to go with bear for myself.
That's very fitting. And Jason?
I guess by implication, I'm the balance, I'm the leftover, but the truth is, I can be whatever you need to be. That's the goal of a good counsel is I can help.
I want my lawyer to be a tiger. I don't think there's anything wrong with that. Thank you very much, everybody.
Thank you.
Really
Thank you.
appreciate it.
Thank you.